Imagine it's the year 2000. You're a 30-year-old office worker earning a steady salary. You follow the advice, spend carefully, save money. You open a savings account. Every paycheck, a portion of your income goes into it. You watch the balance grow slowly. It feels responsible, safe. The number represents discipline, patience, and security, a sense of calm and stability. Fast forward 20 years, your account balance is much larger now. You did everything right, saved consistently. But what that money can buy today feels wrong. A house for $180,000 in 2000 now costs $450,000. College, tuition and healthcare expenses have skyrocketed, threatening retirement plans. Your savings grew, but the world moved faster. The uncomfortable truth: the financial system quietly changed the rules. But the advice didn't. Saving money became complicated. Saving money used to protect people from uncertainty. Today, saving alone can expose you to it. The modern economy rewards movement. For most of the 20th century, saving and security made sense. Banks offered meaningful interest rates, rewarding patience. If you saved $10,000 in the early 1980s, you might earn 8% or 10% annually. Your money was growing, but the financial environment of the last 2 decades operates very differently. Interest rates have been pushed dramatically lower. After adjusting for inflation, the real return on savings becomes negative. Your money grows numerically but shrinks in real terms. This shift happened gradually. Most people never noticed. Traditional advice kept repeating, save money, build security. The problem isn't saving itself. Saving is still necessary. Emergency funds and financial discipline still matter. But the idea that simply storing money will preserve its long-term value is no longer guaranteed. Inflation works in the background. If inflation averages 3% per year, purchasing power is cut in half over 24 years. Money stored safely is losing ground. This creates a strange contradiction. People are encouraged to save, but the system punishes inactive money. Economic growth depends on capital moving. Money circulates through businesses, investments, and innovation. Savings accounts represent money that has stepped out of that cycle. The individual saver receives only a small fraction. This creates a widening gap between those who participate in asset growth and those who simply store money. You see this in the housing market. Prices have risen faster than wages and savings returns. Someone who purchased property decades ago often experienced much larger gains, tied to an appreciating asset. This pattern repeats across stock markets, real estate, and investment funds. Traditional savings remain stagnant. People who store money safely may find themselves gradually falling behind. Saving alone is no longer enough. The psychological challenge is enormous. Saving money feels safe. Watching a bank account grow feels reassuring. There is comfort in stability. But the modern financial system often rewards volatility more than stability. This creates a difficult situation. Keep money in safe storage, and inflation weakens it. Move money into investments and accept short-term losses and uncertainty. There is no perfect option. The system encourages individuals to take responsibility for their financial security, retirement, education, healthcare. Yet the environment grows more complex. Markets react instantly. Interest rates shift. Asset prices respond. For someone trying to preserve their savings, this complexity can feel overwhelming. The old idea no longer holds power. Safety now requires more than storage. It requires adaptation. Money interacts with time in non-obvious ways. $10,000 stored for 30 years is not the same. The world around it has changed. Prices, opportunities, industries all shifted. The purchasing power attached to that money has shifted. This brings us to the deeper reason saving money can become a financial risk. Risk isn't always sudden loss. Sometimes risk appears as gradual stagnation. If savings remain stagnant, the gap between opportunity and reality grows. This is not a criticism of people who save. The instinct to save comes from rational thinking. People want protection from emergencies, stability, and independence from financial shocks. But the system around savings has evolved. Central banks adjust rates. Governments issue debt. Markets create new instruments. Money rarely remains idle. It constantly seeks returns, opportunities, and growth. Inactive money loses power. That is the hidden cost of safe savings. Safety in the short term can transform into long-term vulnerability. Money remains protected from immediate shocks, but drifts further from the expanding edges of the economy. This doesn't mean everyone must become a professional investor. It doesn't mean every dollar must chase risk. What it means is that the modern financial system requires a deeper understanding of how money interacts with time. Saving is the foundation of financial responsibility, but growth is the mechanism that preserves financial strength. Without growth, savings struggle to keep pace. People notice something strange. They worked hard, saved consistently, followed advice, yet the future they expected feels smaller. Not because they failed, but because the financial environment quietly changed around them. Saving money once protected people. Today, saving without growth can create a different kind of uncertainty. Understanding this shift matters. It determines if discipline leads to security, or if it leaves people standing still, while the economy continues moving forward without them. Adapt and grow. Imagine you continued saving money exactly the way financial advice told you to. Every paycheck, a portion goes into a savings account. The balance rises slowly but steadily. You feel responsible. You feel disciplined. The number in the account becomes a symbol of stability. But something subtle begins happening around you. The economy keeps moving, and the speed of that movement begins to matter more. Modern economies do not stand still. They expand, contract, innovate, automate, and reorganize constantly. Businesses compete. Technology evolves. Entire industries appear and disappear within a decade. When money participates in that movement through businesses or innovation, it grows alongside the economy. When money remains stationary, its relationship with the economy slowly changes. At first, the difference is invisible. A savings account might earn a small amount of interest. Inflation might remain low. Prices might rise gradually enough that no one notices. Consider a simple example. If someone saves $10,000 at 1% interest, after 20 years that money becomes roughly $12,200. On paper, the saver gained more than $2,000. But if inflation averaged 3%, the purchasing power actually fell significantly. What $10,000 could buy 20 years earlier might require nearly $18,000 to purchase today. The real economic power of the money declined. This is how saving money can quietly transform into a financial risk, not because the money disappears, but because the world changes faster. This is one of the central realities of modern finance. Time rewards growth. Growth compounds. Inflation compounds. Opportunities compound. Money that participates in economic expansion compounds alongside them. Money that remains stationary does not. Earlier generations operated where savings accounts offered meaningful returns. Interest rates in the late 70s sometimes reached levels unimaginable today. But since then, central banks pushed interest rates downward to stimulate growth. Lower rates made loans cheaper but reduced the reward for traditional savings. The system began favoring assets over cash. Assets like stocks, real estate, and productive resources increase in value as the economy grows. Cash is stable and liquid, but it rarely grows quickly. When rates stay low, this difference becomes more pronounced. Asset prices rise. Safety and growth often move in opposite directions. Safety prioritizes stability. Growth requires exposure to uncertainty. Market declines can create fear. Cash does not create that emotional stress. The balance remains stable, but stability carries a hidden cost. Think about how wealth accumulates. Entrepreneurs build businesses. Property owners benefit from demand. These forms of wealth grow when the economy grows. Savings accounts are largely disconnected from that growth. That is why the traditional advice to just save money has become incomplete. Saving is the foundation, but it does not guarantee long-term security anymore. The modern environment requires a second component: growth. Inflation is subtle, gradual, almost invisible, but over decades it becomes undeniable. A dollar today does not carry the power of a dollar 30 years ago. It is like a boat anchored in a river while the current keeps moving. The boat is stable, but everything else keeps flowing past it. The world where saving alone guaranteed prosperity belongs to a different era. Today's environment requires a balance between safety and participation. Saving money is still responsible and necessary, but it is no longer the full solution. The economy never stops moving. Financial stability depends on whether your money moves with the world or quietly stays behind.